Good evening, everyone. Welcome to tonight's webinar. Tonight, Dana Onspot will talk us through how to make a retirement income plan. The founder and CEO of Sensible Money, she is recognized as one of the nation's top thought leaders on the subject of retirement planning, and especially this most challenging phase known as decumulation. Dana's the author of the widely acclaimed retirement guide, Control Your Retirement Destiny, which you can also find as a podcast on platforms such as Apple, Spotify, iTunes, and Audible. Her online course, How to Plan the Perfect Retirement, is available at thegreatcourses.com, and there are numerous recorded webinars and videos available on our website, www.sensiblemoney.com, and also through our YouTube channel. So whether you prefer to listen, to read, or to watch, there are options for anyone who wants to learn more about what it is that makes planning for spending in retirement so much more challenging than saving for retirement. I'm Nancy Fellinger. I'm one of the financial planners here at Sensible Money, and I'm in Pawleys Island, South Carolina. Dana's in Scottsdale, Arizona tonight. We have team members in other states as well, and some of the same technology that we're using here makes it possible for us to work with clients all across the country. So let's turn it over to Dana to get started.
Thank you so much, Nancy. Well, before we get started, we have to go through our disclosures, of course. So while these are up, I will let you know that there are, of course, no guarantees. I always use case studies in our example. While they are loosely based on real life, they are hypothetical, and they're not meant to be representative of any particular strategy that we use or any particular client result. And of course, past performance is no guarantee of future results. So, with that out of the way, let's talk about what we're here to talk about. How do you make a retirement income plan that accounts for all of the variables? There are things such as your age at desired retirement. If you want to retire at 55, your plan's going to look a lot different than someone that wants to work until 70. If you want a certain lifestyle, we were talking internally today about a client that suddenly wanted their house. Well,
Dana, I'm sorry, I think we've lost sound.
How about now?
Yes, now I'm hearing you.
Seems the bandwidth is low. You know what I might do is try taking the camera out, although I hate doing that, but that might give me a little bit more bandwidth. That's unusual. We're going to keep trying this, and if it doesn't work, we'll go back to the headset. So somebody said I was right near home ownership. And so talking about whether you have a paid off home or whether you have a mortgage, whether you have access to retiree health care, all of those things are going to impact how much you need to retire. And of course, your health. If you're healthy, you're going to possibly live longer. If you're not healthy, you're possibly going to need to spend more on health care. All of these things impact the plan. In addition, we have this timeline here from around age 50 or 55 all the way up now to age 75 for those born in 1960 or later. And this timeline we call the opportunity zone. So when you're looking at the opportunity zone, there's all kinds of things happening. It's a busy 20 years. There's age 59 and a half, the first age you can withdraw from retirement accounts. There's age 60, the first age you could claim Social Security if you're a widow or widower. 62, the earliest you can claim Social Security. Age 63, that's a year that they begin to look back at your tax return to determine your Medicare Part B premiums. Now that look back rolls forward, so it's always a 2-year look back. There's age 65 where you're eligible for Medicare. There's full retirement age for Social Security. There's age 70 where you can now get maximum Social Security. And now you've got your required minimum distributions that start either at age 73 or all the way up to 75, depending on when you're born. That's a lot of stuff going on during those years. And the amount that you can withdraw from different accounts should adjust. Your tax rates will adjust depending on when you apply some of these variables, when you start Social Security, when you take money out of accounts. So there's certain things that are going to be fixed during this time period, and there's other things that you're going to have choice. And the way you manage these opportunity years and the decisions that you make during this time can also have a big impact on your plan. And that's what we want to talk about. We want to look at an example of how you might navigate some of these years. So here's an overview. We're going to start with part one, where we're going to be talking about income and what is income in retirement. We're going to move into part two, where we're going to be looking at an example of a spending plan. Then we'll talk about part three, the gap, which we define as what you will need to withdraw from your portfolio. So think of it as the portfolio paycheck portion of your retirement cash flow. And then there's part four, the investments. Once you have a plan in place, how do you line the investments up to match that plan? So part one, here we go. When you look at income, well, how do you define income? How do we define income? For many of us, income is what we make while we earn. And I've had clients tell me, next year, I won't have any more income. I won't be working anymore. And it always makes me chuckle because, of course, I do realize that that's exactly what we're planning for. But in their mind, and as many of us define income, it's what we're making while we're earning. Then there's how the IRS defines income, which is taxable income. What will you actually pay taxes on? And then there's how we define income, which is in terms of cash flow. And cash flow may or may not be taxable. It may come from an IRA, it may come from a pension. It's all of the resources available that are delivering the cash flow needed to maintain your lifestyle. So let's take a look at this taxable and this cash flow piece in a little bit more detail. First, when we're looking at taxable income, there are sources that are taxed at the highest tax rate: pension, withdrawals from traditional pre-tax IRAs or 401ks, up to 85% of your Social Security, deferred comp distributions from corporate executive benefit plans, interest from government or corporate bonds, interest from certificates of deposit or now money market funds, now that we can actually earn interest again. All of these things are taxed at your ordinary income tax rate. Then there's an alternate tax rate. I guess I'll say alternate tax rate. It applies to long-term capital gains and qualified dividends. So if you build up assets in a brokerage account, things like stocks and mutual funds, you can have a certain amount of income and gains that qualify for what might be a preferential or lower tax rate than your ordinary income rate. And same if you own real estate. When you sell a property, there's something called depreciation recapture if you've been able to depreciate that property over time. But generally, it's going to be a lower tax rate than what your ordinary income, or it may be lower. That's why we call it alternate. It's not necessarily guaranteed to be lower if it's depreciation recapture. Then there's items that aren't taxed. So you have Roth IRA withdrawals, assuming you follow the rules, of course, interest from municipal bonds. You have a portion of your long-term capital gains. If you can realize capital gains in a low tax year, you may be able to have those gains qualify for the 0% tax rate. There's qualified health savings account withdrawals. There's withdrawals of bond maturities or other principals. So for example, if you own a bond or a certificate of deposit in an account and it matures for $50,000, when you withdraw that $50,000, it's not taxable. The interest on it was taxable as you earned it, but the principal when it matures is not. And we often have people say, yeah, but if I withdraw that, isn't that $50,000 of taxable income? Well, no, if it was in your IRA, it would be, but if it's not inside a retirement account, those kinds of things are not taxable. And so there are ways to structure your retirement income to be as tax advantaged as possible for you. And that's by understanding and deciding which investments should go in which accounts, and by deciding when you should take money from one type of an account versus another. Regardless of how it's taxed, it's all cash flow. So all of these different things form cash flow that's available to you. Same, we could break income into what we call non-portfolio income or fixed income coming from pensions or Social Security, or income coming from a rental property. And then we could look at the portfolio paycheck side, whether that be from IRA or 401k withdrawals, Roth withdrawals, mutual funds, stocks, bonds. And so again, regardless of where it's coming from, they're both cash flow. Now, the way that we as planners or experts in retirement income planning view it is in these two buckets. We look at what we call non-portfolio income, and we like to lay out what is that? Where is it going to come from? What is the timing of it? And then that allows us to calculate what would the portfolio paycheck portion need to be in order to maintain someone's lifestyle. So let's look at a case study. Larry and Ellen. Larry is 69 and Ellen is 62. Larry is retired and Ellen is still working. Neither has started Social Security yet, and Larry has a small pension of about $5,000 per year. Let's take a look at their net worth statement. Larry and Ellen have about $367,000 in a joint brokerage account. Larry has some IRA accounts, and Ellen has some IRA and 401k accounts. They each have Roth IRAs, and they have a paid off home. Oh, it's not paid off. They have a small mortgage, and they have, of course, working capital, as we call it, in their checking account. So overall, Larry and Ellen are worth just over $3 million. Well, what we want to start with is laying out Larry and Ellen's what we call income timeline. Now, when we say income, in this case, we're not referring to all of the cash flow available for them in retirement. We're referring to the non-portfolio piece. This is the amount of cash flow that's not coming from their savings and investments. And so Ellen will have her last year of earned income, and she is likely to start Social Security this year. Larry has a pension, and then we can see Larry will start Social Security next year. And when we forward out to the year they're both receiving Social Security and pensions, they'll have about $89,000 of fixed income. But Larry and Ellen don't want to live on $89,000 to $90,000, right? Nor should they. They have other resources, so they really want to know, well, what can we do in retirement? So as I was saying, Larry and Ellen, they shouldn't have to just live off of this fixed income. They want to know, well, what's sustainable? How much can we spend? What can we do without obviously spending too much to risk our future? And that is the balance. So when we look at part two, spending, it's, well, how much can I spend now, the 65-year-old me, but I don't want to spend so much that the 85-year-old me doesn't have enough. And so it's always this process of finding that sweet spot, of finding the balance between how much you can spend now while still making sure that the 85 or 90-year-old you will be okay. The first thing is breaking your spending down into different categories. And these are the general categories we use. There's fixed expenses, things like a mortgage, they're not inflating. There's recurring expenses, home insurance, utilities, your cell phone bill, groceries, eating out, gas, health insurance. These things are going to occur on a regular basis, and they're likely going to go up over time. There's annual expenses, things like property taxes. If your mortgage is paid off, that might not be built into the mortgage payment. Insurance premiums, some people pay their auto premiums or long-term care premiums or homeowners insurance once a year. Those things are going to occur annually, and they will have inflation. Sometimes people forget to build these expenses into their budget because they're looking at their monthly items only. And then there's periodic expenses, things like auto purchases. They don't happen every year. Major dental expenses, they don't usually happen, if we're lucky, every year. And major home repairs, things like roofs, or having to redo the electrical, or having to redo the deck, or the pool if you're in Arizona. So those are major things that, again, they might happen on a periodic basis throughout retirement, but they're not going to happen every year, but you still have to have some way to account for them. You also need to account for the different spending patterns that occur as we age. So typically early in retirement, you've heard me say this, we call it the go-go years. People are traveling and they're healthy and they're able to do things and they're out doing things. And then somewhere between maybe early to mid 70s, the slow go years happen. And it's different for every person, but people tend to slow down. They're not traveling as much. They're not buying as many things. They're not out, in entertainment venues as much. And so their spending often slows down during this phase. And then there's what are sometimes called the no-go years, where health issues show up, people are home quite a bit more, and sometimes spending can go back up during those years. You might need more help at home. You might need someone to come in and do the cleaning or the cooking, or you may need help folding laundry. There's all kinds of things that you may need help with as you enter those slower years. You can account for these spending changes. So let's look at Larry and Ellen's spending timeline. We see a mortgage out here, and at some point in retirement, it is paid off, but here I'm just showing the first 10 years of their retirement. And you'll see that that item is fixed. Next, we have taxes and insurance and home upkeep and repairs, and there's a 3% inflation rate being applied to those items, so they're going up each year. Next, we have living expenses. That's all those recurring items. And so they're going to occur every year. They're lumped together, things like gas and groceries and cell phone, and we've applied inflation to them. We also have periodic items like car purchases. So we see a car purchase out here. I know there's additional car purchases in their plan. And so that particular row may be hidden in this screenshot. There's also vacation, and this is one of the ways you can account for the difference between the go-go years and the slow-go years, with vacation spending at $15,000 a year early on, and then perhaps dropping down to $10,000 as they might enter their slow-go years. And then there's other expenses. We've got healthcare, out-of-pocket, and other things you need to account for if Ellen were to retire before she reaches the age of 65, she's going to have to buy a healthcare plan, probably off the marketplace, what's called a marketplace plan off of healthcare.gov. And so we have over $1,000 a month built in for the potential cost for that plan. And then that would go down once she was fully on Medicare. So that is an expense you would need to build in if you plan on retiring before age 65. We also see Medicare B and D premiums in here. And so once you're on Medicare, sometimes people think of Medicare as free, but in fact, there is a component of it that you pay for. And what happens is you will pay that through an invoice if you're not yet collecting Social Security. And if you are collecting Social Security, then they will debit it or deduct it right from your Social Security check. And then we also have taxes down here. Now the taxes are being auto-calculated by the particular model that we use, and there's some other components in impacting these taxes that we haven't yet talked about. So we'll be looking at that at that next. Now, one of the things that we're also accounting for here are different inflation rates. And so while we're using 3% on most of the recurring items, living expenses, taxes, insurance, we're using 5% on healthcare related items. And that may not be as high as we're thinking, but many retirees are very concerned about the potential cost of healthcare. And if this amount of out-of-pocket and healthcare spending is not needed each year, then of course that just provides more money to be spent on some of the go-go spending or other fun things. But we want to test the plan as if that level of spending on healthcare is required. So I mentioned taxes. So part of the spending, of course, is taxes. And that is something that, believe it or not, many people planning forget about. And so they might be reading an online article, something like the 4% rule, and they might say, oh, you know, great, I'm just going to total up my assets times 4%, and that's what I can withdraw in retirement. But if all of that money is inside of tax-deferred retirement accounts, then they have to account for the tax impact. It's going to be taxed. And sometimes, believe it or not, very sophisticated people forget to accurately factor that in. So in this model, there's also projected income for taxes. And you'll see estimated adjusted gross income, estimated taxable income, and the top marginal rate. Now here we see that top marginal rate going up in a few years, and that is because under current law, the rates are set to revert in 2026 back to what they used to be about a decade ago. But it's these tax rates and the actual tax code as it stands today that is being applied to their income to come up with these estimated total federal taxes. Now, these federal taxes, as I mentioned, are being impacted by the amount of withdrawals that are being taken from the different retirement accounts. So how do we account for that? Well, that's part 3, what we call the gap. So we looked at the income coming in from non-portfolio sources, things like Social Security and pensions, and then we looked at all of the expenses going out, and the difference is what we define as the part that needs to come from the portfolio or the portfolio paycheck. When we look at Larry and Ellen, if we see, and if we were to go back a few slides, you'll see that their total income adds up to what's shaded in blue here. And their outgoing cash flow adds up to what's shaded in this peach color. And then the difference that's a little bit larger is what we define as the gap. And for my math nerds or my people that eyeball this and they're really good, then they're going to look down here and they're going to add up. Underneath, we see exactly where this $59,000 is going to come from. We're going to take a $50,000 withdrawal from Larry's retirement account, and we're going to take a $13,000 withdrawal from their non-retirement brokerage account. And you go, well, wait a second, that's more than the $59,000. And that's because Ellen is still working this year, and she's estimated to put in just enough to get the company matched to her 401k plan, or about $3,300. And so you're going to see exactly a $3,300 difference between this gap here and if you were to add up these two withdrawals. So basically, it's like taking money out of one IRA account, but $3,300 of it was going back into her workplace plan just so she could get the match. And then you'll see the employer deposit. This is the match portion, so it wouldn't come out of this couple's cash flow. So we see these total withdrawals here, and then we can see account by account where they would come from each year. And in the first 4 years, they're estimated to be fixed withdrawals, but you see at 73, Larry is reaching required minimum distribution age, and so that's why you then see the amounts vary with Larry's projected required minimum distributions out here. So this gives us a 10-year snapshot of their expenses, but what we really need to know is we need to look at it over their lifetime. Now at the bottom, you can also see the projected total account balances of all of their accounts, and we can see that at least in this first 10 years, those accounts not only maintain themselves, but they actually potentially grow. And here we're using a hypothetical 5% return for testing outcomes. So if we're going to look at this over their lifetime, this is a lot of numbers on one spreadsheet, but what we're seeing here are the Social Security and the pension, and Section A gives us all of their what we'll call normal income, what most of us think of as income coming in. Next, we add to it all of the withdrawals, gross withdrawals. We haven't factored in taxes yet, and those total up to Section B. And when we add A plus B, less any amount that went back into savings in this account, there's a piece that went back into Ellen's workplace plan, then we are left with D. This is the total cash that's actually available for consumption. And if our numbers match, then we're going to see exactly where every dollar that's available goes. Now you'll also see at the top here, we have the account balances projected, or the starting account balances at least for each account. So next, where does that money go? Well, this is section E, and we have the different expending categories. They're the exact same expenses we showed before, but they're grouped together into different categories here. And here we see these periodic auto purchases coming through. And so this gives us our total outgoing expenses. These are going to match dollar for dollar our total incoming cash flow here. And then we can see this monthly amount, which is after any potential auto purchases. And so that is more of a kind of a gut check, right? So are we spending about $12,000 a month? That is what we're going to have to budget with. Now we're going to have to pay for our healthcare premiums out of that and so on, but it allows people to compare that to their take-home pay now and kind of say, okay, do these numbers add up? Now, if this is what Larry and Ellen decide to do, then we see their projected trajectory. These are their different account types. The color codes are, how much they have in various accounts. And for example, if Larry's Roth account suddenly disappears, what happens is it all passes on to Ellen. And so it doesn't actually just disappear. It just rolls into Ellen's Roth here. This yellow becomes the blue. But this looks like a pretty solid plan. They've maintained assets throughout retirement, and they may decide, you know what, we'd actually like to spend a little bit more. We don't have any children, and so we, are okay with spending this down by about half. That may be a perfectly acceptable outcome for them. And then we could go back in and say, well, what if you want to travel a little bit more in early retirement? What would that look like? So there's different iterations that they can do to account for those go-go years. And once they see what's possible, that allows people to kind of go, oh, okay, well, maybe I could do this or maybe I could do that. Now, while this gives us a general trajectory here, we like to use something called a fundedness ratio. So if you've ever worked for anywhere that had a pension plan, I know they're not as common anymore, but they will send out an annual statement telling you the fundedness of the plan. And so this is a very similar calculation where we're taking the present value of all of the withdrawals from the account. So if I go back a few slides and I say, all right, here are all of the withdrawals we're expecting to take over Larry and Ellen's lifetime. Well, if I take the present value of those withdrawals, assuming approximately a 4% discount rate, or meaning if I had 1.847 million in the bank earning 4% a year, then it would deliver that stream of cash flows. And so we compare that present value number to the assets that they actually had at the beginning of the year, and we end up with a fundedness ratio. And so in this case, that fundedness ratio is positive. Now, think of this like a lifetime withdrawal rate. So there's a lot of, articles out there about how much you can withdraw in percentage terms. We were talking before the webinar started about a Reddit thread that's gone around saying you could withdraw as much as 8%. And the reality is there's some years where you can. So if we were to go back and look at years where Larry and Ellen buy a car purchase, well, that might be something they pay for with cash, and they will be withdrawing far more than 4% of their portfolio, most likely during those years. So how do you know, if you can't measure year by year, how do you know if your plan is sustainable? Well, we like this lifetime withdrawal rate. And if you want to take a look, there's 2 free handouts that I've attached. There should be a handout section. One of them is called Don't Cheat Yourself with the 4% Rule, and it talks a little bit more about some of the I don't want to call them problems, because I think the 4% rule is a great rule of thumb, but some of the challenges that can come up if you try to actually apply that to the specific amount you want to withdraw each and every year in retirement. So I think that's a great report to read. It's also available from our website under the Learn tab. There's also a second downloadable PDF that has the Opportunity Zone slide that we looked at earlier. So now we've looked at Larry and Ellen, we've looked at their income coming in, not from the portfolio, their expenses going out. We've looked at the gap, we've tested the gap, and the gap looks sustainable. It meets all of the ratios we want it to meet. We give Larry and Ellen the thumbs up. Your plan looks great. Now, how do they begin aligning the investments to the plan? Well, we talk all the time about discipline and diversification, and if you follow any kind of, personal finance, you're going to hear those things. And despite that, we are humans and we are ruled by emotions. And so it never fails that whatever current event is going on, we always think we should be changing our portfolio based on that current event. And I was recently seeing a great example of that where, and we were talking internally about, what do we do for our investment process and is it special? And we're like, it's disciplined, it follows a process. And I think the challenge is so many people don't invest with discipline and don't follow a process, that if you are disciplined and follow a process, it's those results just compound over time, and it delivers a far better outcome than if you're always shifting your money around or trying to change based on what you saw in the news or what economic indicators came out or what the latest earnings report said about your favorite stock. So we see that it's not that it's some magic secret sauce for investing, but the ability to use discipline and know why and when you rebalance and use diversification, that these really boring investment principles that are so hard to do consistently, those are the things that actually make the difference. And unfortunately, as human beings, we are not wired that way. We're very much wired to want to always be taking action and thinking we can beat the market or do something exciting. And we see a lot of bad outcomes from that. So when you're looking at the investments, here is the way that we prefer to do it that helps mitigate some of what we call behavioral risk. And behavioral risk is exactly what I was talking about, that desire or tendency for us as humans to be very reactionary to what's happening. So if Larry and Ellen, if we look at the items highlighted in orange, these are the withdrawals they would take by account level. So there's certain cash flows coming from Larry's account, certain cash flows coming from Ellen's account, and certain cash flows coming from their joint brokerage account. Now, if we were to buy bonds or CDs, fixed, stable type of investments that are going to mature each year to meet these cash flows, then that would take up about $692,000 of their $2.2 million portfolio. Or it would result in about a 31% starting allocation to fixed income. Now, that's not necessarily an allocation that would get rebalanced to every year, but it gives them a starting point to say, okay, starting in 2025, you are going to have what we call a runway, these safe investments maturing each year. So if in 2025, your first full year of retirement, the stock market's down 25%, that's not going to impact this $109,000. These are going to be bonds that mature. And so while this type of strategy isn't guaranteed to deliver results any more superior than anything else that someone might do, we find it has certain behavioral aspects. People go, oh, okay, if the stock market's down 25% or even just 10%, I get it. I have these bonds maturing. That's where my cash flow is coming from. That buys the rest of my portfolio a lot of time. And so as you consume these bonds, let's say you're 4 years into retirement, well, somewhere along the way, there were also good years, hopefully good years in your portfolio. And during those years, bonds were being, or stocks, part of the growth portion of the portfolio was being sold, and you would be buying bonds out here maturing in 2033. And so as you go forward, if you were partway out here, let's say 2028, you should still have close to 8 years of a bond ladder left. It's a process that continues on once you're retired. Now, if you want to see what it might look like, this is account by account, and these are samples of the actual bond amounts that would come in. This is Larry's IRA, the second one is Ellen's IRA, this third one, we see these spikes from their joint brokerage account, and the reason we have these spikes is here we see, for example, car purchase years, 2026 and 2031. So that would entail spikes. And this is what that total would look like. And we can take all of those cash flows, and we work with an investment partner called Asset Dedication, and they calculate what's called the minimum return. So what does that mean? Well, these dotted white lines here represent the minimum amount that Larry and Ellen would need to have left each year for their plan to work for life. Meaning, if they're going to pass in 2045, then in 2044, they're going to have just enough money left to spend for their last year of life. And then the year before that, just enough money left to spend for their last 2 years. So it's not an expected path. It's really a worst case scenario. How do we measure against this? And we obviously would like to stay in the green. But the great news is Larry and Ellen's portfolio only needs to earn about 0.38% to stay above or at their critical path. Now, if this portfolio was required to earn 7%, we might say, I don't know if that's realistic, and we would have to either adjust their spending or suggest that they work longer or suggest that they might have go-go spending for only a few years, but then the travel expenses would have to back off later. There's all kinds of variables that could be played with. Then Larry and Ellen's withdrawals are tested over history, what's called a historical audit. And in this case, it went back to 1927, and each yellow line represents a distinct 21-year period. And so the Great Depression is in here, and we can see that if Larry and Ellen retired during one of those times, they would have watched their portfolio go down to below $1 million. That would have been terrifying. But if they stuck with it, it would have recovered. And in their case, all of the yellow lines finished in the green historically. However, there's some that followed that critical path line pretty closely. Now, these yellow lines assume that absolutely no changes were made. If this in fact was Larry and Ellen's plan and they were out here 5 years into retirement and their portfolio balance because of the market was substantially less than where they started, most likely they would make some adjustments in their spending also, and that would help that would help their scenario come back up into the green and make sure that they had enough. So that is how you put together a retirement income plan. We are going to open it up for Q&A.
What is the formula or rule of thumb to guide a client in choosing between taking a lump sum pension payout or monthly payouts for life?
So it's generally the similar formula to what we just showed for fundedness. So what we do is we look at the cash flow that you could get from the pension. So if you took it as an annuity, and then you turn that into a present value, right? So what would you have to have in the bank today, earning what rate of return to deliver that same stream of cash flow? And oftentimes we'll see that you would have to be assured of earning, let's say, at least 7% on your portfolio for it to be the smart decision to take the lump sum. Our general cutoff is somewhere around 4 or 5%. When you look at historical portfolio rates, there's been many times in history where your compound rate of return would be less than 6%. And so to us, that's a big risk to take, to say, well, if you live long, that pension's just going to keep paying out. And if you want to take that risk to take the lump sum, and you would have to earn at least 6 or 7% in order to have it pay out for life, maybe that wouldn't happen. So that's generally the formula. I mean, we run it in an Excel spreadsheet. There's also online calculators or spreadsheets you can download, but that's how we think about it.
Okay, question, Dana, on Charles Schwab. So with Schwab being Sensible Money's custodian, what are your thoughts regarding their financial health? So the question has to do with concern about their share value having fallen last year, being down this year. They're preparing for another uncertain year ahead. Do you share the concern? If yes, why? And if no, why? Would my portfolio be 100% safe in the event of insolvency?
So I think people confuse the evaluation of a stock price with a business model and whether a business is working and functional. And so I know there was an article in the Wall Street Journal. You know, I think you use probably a lot of service providers that if somebody was going through their financials, they would probably be insolvent and almost never running at a profit. And so when you're looking at big publicly traded companies, of course, they're going to say, oh my gosh, their profits are down. Does that mean that they're in trouble? They're evaluating it from an investment standpoint, meaning they're looking at Schwab's stock, right? Should I buy Schwab's stock? They're not evaluating it from a service provider standpoint, like is Schwab, going under, or is Schwab worried about being insolvent, or should Schwab's clients be worried? So those are two different things. And so, no, I am not worried at all, because I understand what the analysts are looking at and how they're evaluating the financial statements. Two, if you look at what happened, for example, back in 2008 and 2009 with Lehman Brothers, when you have assets at a brokerage account, those are your assets. Those are not assets of that brokerage account. And so that's what the term custody means. They're custodying the assets for you, but if something happens to that brokerage account, those assets get ported or transferred to whoever the new company is that takes over. They don't get absorbed and available for the general creditors of that company. And so, no, this is not something that concerns me. It is something, of course, whenever something like that runs in the Wall Street Journal, that we get asked about quite a bit.
Okay, there's a question that is really specific to a situation, so I'm just going to try to figure out how to ask it so that it's a bit more generic. Let's say that someone needs to apply 35, 40% of their allocation to bonds to create an income ladder. But they're concerned about tax liability with capital gains, as they would need to sell a portion of the portfolio. So how would you go about looking to minimize tax liability with capital gains, and how long would it take to create an income ladder in the event that there would be substantial gains?
Well, famous answer, right? It depends. And so that becomes an individual discussion where we look at the risks. So sometimes we might say, okay, your tax optimized plan says you should spend out of this brokerage account, but that brokerage account is all stocks right now. And we've encountered this a lot. If we were to sell all of those stocks and create a bond ladder, the capital gains are going to be significant. So what can we do? Well, we can take a more measured approach and slowly sell the stocks. Now that might put more pressure on your portfolio in a down market. So how do you feel about that, right? It entails more risk. Are you comfortable with that? That becomes one question. We could also say, well, we're going to create the bond ladder, or at least a portion of it, in a tax deferred retirement account. That's not our ideal place to withdraw from, but if the market tanks and we go through a few bad years, then we could take the money out of the IRA and we could take a slower approach now to realizing those capital gains. The other thing that becomes a factor is your tax rate. If you're working now and you're in a higher tax rate, and we can project out that there might be a year or two in retirement where some of those gains could be taxed at 0% or at 15% instead of 20%, then again, that becomes a discussion to say, what's most important to you? And there's so many things, if you've heard me say this before, like a lot of times we'll frame discussions as red, yellow, green. Like red, don't do this. Green, you have to do this. And so many of them are yellow. So we might say, well, if your primary goal is to hedge market risk, and then we're going to just, pay the taxes and create that bond ladder. And if that's what's going to allow you to sleep at night and have a more gradual transition, or have a comfortable transition into retirement, then fantastic. But There's other clients who say, you know what, I don't want to take that big tax hit. And I've even had people say, and if the market goes down right before I want to retire, I'll just work longer. I would rather actually do that than pay all these upfront taxes to transition my portfolio. So they're obviously very comfortable with risk and with taking a more measured approach. So I wish I had a crystal clear answer, but those are the kind of discussions that we might have to figure that out.
So a couple of questions, Dana, on annuities. One is, why aren't annuities an income source? And the other is, what about fixed annuities with income riders? This is something you rarely discuss, but it can be taxable and in some cases tax-free.
Yeah, so annuities are certainly an income source. If they weren't on my drawing, or in that list, then I thought they actually were somewhere in there, but if they weren't, I'll have to add them in. But whether they're, how they're taxed is going to depend on where they're owned. So if they're in an IRA account, then the tax treatment of that IRA is going to dictate how those withdrawals, are taxed. And if they're in a non-IRA account, then there's a basis to them. And most of the time, if you're just taking withdrawals, it's ordinary income that comes out first and your basis comes out last. If you actually annuitize them, there's a different tax treatment that applies called an exclusion ratio. So there are definitely fixed annuities with income riders. You're right, I don't discuss them that much. They fall under that, what we call fixed income piece. So what we'll often do is test for an annuity. And in this last year, because interest rates have been higher, we've actually done a lot more of that. So we might say, okay, if I took $200,000 out of your IRA and instead we put it in this deferred annuity, it's going to start paying you a guaranteed amount in 10 years. What does that do to your plan? And we measure it in terms of something called a coverage ratio. So we will look and say, okay, that means now 50% of your expenses in retirement would be covered by fixed income. And what does that then do to your fundedness ratio, right? And so what we want to know is, if we put this annuity in place, does it make your plan metrics improve? And for many years, the answer was no, because the annuity payouts weren't that great. But with interest rates a little higher, we've done quite a few plans this year where if you took a portion and put it in an annuity, it does make the plan metrics look better. Now, typically, because of taxes, we are looking at doing that within an IRA account. There's all kinds of reasons for that. I'm not saying that is always the right decision, but oftentimes because of the tax treatment, we prefer to do that because that's going to get taxed as ordinary income anyway, versus if I take it out of a brokerage account, well, those are assets that qualify for that preferential tax treatment of long-term capital gains and qualified dividend. And we don't really want to take that kind of asset and then turn it into taxable income.
Okay, we've got a question regarding planning for spouses who have a 20-year age difference. Could you please address the planning challenges of a couple with a significant age difference? My husband is 20 years older. He is planning to retire in a couple of years at 70, and I will be dramatically cutting down on work to spend more time with him, so essentially partially retiring as well.
That is a challenge. I've done many plans for people with these kinds of age differences, and the big challenge becomes we now have such a longer time frame to plan for, right? So let's say it would normally be 20 or 25 years for the first retiree, but now we've got an additional 20 or 25 years for that second person. And so one of the things becomes, making sure that first retiree delays Social Security to age 70. That maximizes that guaranteed income that will also eventually become the survivor benefit. Annuities can be looked at. There's been many cases where we actually looked at life insurance as a good solution for an age gap. So if the older spouse was still insurable, then that could be a way to say, okay, we're going to fund this life insurance policy, and that's going to essentially refill the retirement plan at the first spouse's passing. But there are definitely challenges with it, and without knowing the specifics, it's hard to know what some of the solutions are. Part-time work, having, the younger spouse willing to go back to work, or we've had cases where the plan simply wasn't going to work and we realized that, the younger spouse was going to need to re-career or find a career that they could stay at for longer. And so it does definitely present challenges, and the best thing you can do is look at the numbers and be clear now what those challenges are. What you don't want to have happen is to be faced with those challenges 20 years in the future.
Okay, what assumptions, Dana, are used to project lifespan?
So we start with a set of default assumptions, which is typically 85 for males and 90 for females. But it's also a plan horizon. So before retirement, we're often using about a 30-year plan horizon. But as people get closer and closer to retirement, we're running it to 85 and 90, and then every year we're running at least 20 years. So obviously we have clients in their 80s, right? So, I have one, you might have heard me talk about them before, whenever I run their plan and they're like, well, I'm not going to live that long. Well, they're in their mid 80s. And so we're running the plan to 100. And so as you go forward, we're always forwarding that plan a year at a time. In my view, you don't need to run a 45-year plan, if you're retiring at 55. I don't think that makes sense. You could run a 30 or 35-year plan, and then, every year, as long as it looks good for the following 30 years, you're going to be in good shape. There's too much that's going to change over 45 years to run a 45-year plan horizon.
Where in your sequence of spreadsheets would you calculate Roth conversion amounts for the years before RMDs and Social Security?
Well, it would entirely depend on the person, right? But usually it's during those opportunity years, and we definitely have the ability to test different Roth conversion amounts. We look at tax rates. So in this particular scenario we were looking at, there wasn't a big opportunity to do Roth conversions, but sometimes during those opportunity years, there are years where their tax rate might only be 10%, and then later it's going to be 28%. And we might say, okay, let's put a series of Roth conversions in here. And again, let's see how that looks in terms of your plan metrics. So does it increase the expected after-tax asset values you would have at the end of the plan? Does it increase your fundedness ratio? And so we want to see at least that those metrics are neutral when we do a Roth conversion, because the likely outcome is we're going to put the assets with the most growth potential in the Roth. And so over time, that's going to make that strategy look even better than what it would look like if we're just using a set of kind of equivalent numbers in the projection. So we think of it like a doctor. First, do no harm. If we do the Roth conversion and everything earns normal rates of return, does it still look just as good as if we didn't do them? And if the answer is yes, then there's other factors that we think make that Roth conversion look even more attractive.
The critical path is great. Is there a similar tool for individuals to try? I see from the website it is for advisors only, and I'm assuming I see from the website, assuming it's the asset dedication website.
I don't know of any consumer tool. If you're an Excel person, you would be able to, basically create a form of a critical path using a present value calculation year by year in Excel. It would take quite a bit of work to do it, but I know I have people out there who watch and create their own spreadsheets who are probably capable of it. As of now, I'm not aware of any kind of online tool that does it.
Is there a rule of thumb for the percent of the portfolio to have in cash reserve at the time of retirement? And maybe this is also a good time, Dana, to talk about just reserves in general and how we treat reserves in a plan.
Yeah, so there isn't a rule of thumb because everybody's different, right? Some people retire with 1 million, some people retire with a couple 100,000, some people retire with tens of millions. And so you know, the nice thing is once you're over 59 and a half, almost all of your accounts are now accessible, right? It's not, oh, there's going to be a penalty. They're all in a sense liquid, but there might not be liquid assets in them. So we think of reserves more as what are the assets we're going to leave out as not available for cash flow in retirement in case something extra comes up, an emergency with an adult child, you know, a big unexpected home repair, a health issue that requires a lot of alternative care that isn't covered by your insurance. So there's all kinds of things that you might want to have some reserve assets for those just in case scenarios that weren't included in your plan. We will ask people, what's your comfort level, right? So is it, you know, 50,000? I have a lot of clients that want to have around 50,000 in a checking savings account that's outside of their investment portfolio. I have some clients that runs closer to 150 to 200. I have some clients who are fine with 10,000. And so it becomes very, very difficult to gauge because a lot of it's based on your spending and, you know, the kinds of unexpected or spur of the moment things that you want to be able to do without having to email and say, hey, you know, I need some extra withdrawals from my account.
Is there, I'm sorry, when does one's portfolio paycheck include money from Roth accounts?
Typically, it doesn't include money for Roth accounts till the tail end of the plan, but sometimes there's lumpy purchases like auto purchases that we might go in and say, oh, you know what, you know, in 10 years, if we were to take that extra at that point, let's say $60,000 out to buy a car, if it all has to come out of the IRA, that would bump you into a higher tax rate. And so that may be a case where either some or all of the money would come out of the Roth. But most of the time, we want to let that Roth grow as long as possible in that tax-free environment. And so you'll often see Roth withdrawals at the tail end of the plan, or in many cases, we don't ever expect to withdraw from the Roth. That becomes the asset that gets passed along to the next generation.
How do you, this one made me smile, how do you determine the order of accounts to take withdrawals from, and then, sorry for the bad grammar, I think it's from which to take withdrawals, but it's fine. You know what the question is.
I know what the question is. So we do it by taxes. So it's not like you always do this and then this and then this, right? It's all based on taxes and certain things, like let's say somebody has a deferred compensation plan. Well, that already has a prescribed set timing in terms of when the withdrawals. If they're still working, sometimes there's an ability to go back in and say, let's spread that out over 10 years instead of taking it as a lump sum. So there's things that can be adjusted. Social Security, when you start that. Your pension, what age you start that, although many times it is 65 that makes the most sense. And so then it's adjusting around all of those things, saying, well, what would your tax rate look like? And each year, what makes sense? Should it come out of the regular IRA? Should it come out of the Roth? Should it come out of the brokerage account? And if the brokerage account, what are the tax implications if we have to sell an appreciated asset like a stock or a mutual fund? So there isn't a nice, neat rule of thumb. I will say, in general, people that have a high baseline of income, pension plans and deferred comp plans, for example, it's probably going to make the most sense for them to not touch their tax deferred assets until required minimum distributions start. For other people without that higher baseline of income, it often makes sense to take money from those IRAs earlier in the plan or convert to Roths and you know, that's just kind of the way it works. So there's some people where we might say, nope, you're not touching that money till your required distributions. And there's others where you could see withdrawals from IRA accounts starting right away because their tax situation looks completely different from each other. I don't think my grammar was all that great either, by the way.
That was fine. In opportunity years with low income and you want to take some capital gains at 0%, can you sell and buy similar ETFs or must they be mutual funds?
Well, you can sell and buy similar ETFs or mutual funds, but it's still going to be taxed when you make that transaction. So I'm not sure.
I think maybe gain loss harvesting is what we're referring to here.
Yeah, so, yeah, you could, for example, sell one S&P 500 ETF and buy a different S&P 500 ETF. And my understanding is, yes, they might have different expense ratios. There might be a different provider. So a reason to make that change, and that you would be realizing that gain, or that gain at 0%. I think what you're asking about is, why is the term slipping my tongue? If it's a wash sale rule. And so I don't believe that even if it's both S&P 500 ETFs, that's going to trigger the wash sale rule. I think that's perfectly okay.
What is the relationship with sensible money and a client after a juicing plan without managing the portfolio? Is it one and done, annual review for a set time? What would the relationship be?
Yeah, good question. It really depends on the client. We find most people who are more the do-it-yourself investors, don't need to come back every year, and our services aren't really set up to do a reoccurring like financial plan. And so for most people that hire us just to do the juicing plan, they are looking for someone to double check their work. We get a lot of that. They just, retirement is a big decision. And so they just want, like, what am I missing? They know there might be some little things that we can suggest or offer that they hadn't thought of. And so then they're happy and content taking that out and executing it on their own. I have had clients that come back about every 3 or 4 years. So we've had, I think our longest client has done 3, maybe 4, I know for sure 3 juicing plans with us over a period of about 11 years. And so they were comfortable going out and taking it. And then when a material change happened, they wanted to come back in and have it retested. But there are a whole group of planners that have a different kind of service model that is set up more if you're looking for like ongoing hourly advice. But unfortunately, we don't have that set up. And when we've tried it, it just hasn't worked well. It doesn't allow us to also serve our ongoing clients in a good way.
How far out should you have a bond ladder? 3 years, 5 years, 8 years?
So we like somewhere in that 6 to 8 year range. The length of the bond ladder can also depend on many things. So sometimes it's a bridge until full Social Security benefits are starting. So if someone was retiring at 65, the primary purpose of that bond ladder might be getting them till age 70. Sometimes, the length of the ladder can depend on interest rates. Now that we actually can earn interest, there's a little more incentive to lengthening that bond ladder and locking in higher yields, versus when interest rates were low, there was a tendency to maybe have shorter bond ladders. The interest or the bond ladder also depends on your risk tolerance, right? So just like, traditional portfolio models will depend on risk tolerance, some people want just the security of knowing, like, I want 8 years of income covered by these safe investments. And I've had other people that go out of their way. I mean, I just had a client, we were dialoguing and extending her bond ladder. And she said, just want you to know I'm very comfortable with risk. And so instead of extending it 2 years, we just did 1 year. And so those are dialogues we have. It's not a set formula. You guys probably are like, it depends. But the reality is you're each individual people. And so it's a very personal decision. That's why it's personal finance. And so it's very difficult to come up with a one-size-fits-all answer to a lot of these questions.
A Roth conversion's best up to the top of the 15 or even the 22% bracket today. When is the break even for paying taxes in advance versus pre-tax growth and paying much higher taxes later?
Well, that's another one of those. It depends on, your individual situation, right? And so, if you're going to be in a 37% tax bracket later and you're going to pass on a lot of assets to the next generation, you might do Roth conversions up to the 33%, right? You might do them all the way up to 35%. If you are only going to be in the 15% tax bracket later, you might not do Roth conversions at all early in retirement. So it's very difficult for me to say that there's a tax rate that's a break even, because it depends on each client. We run it out and say, well, what would your after-tax portfolio value, quote, at death be? And where's the break-even point based on this Roth conversion path that we're projecting? And so let's say you're getting ready to retire today, and that break-even point was 20 years from now. You might say, oh my gosh, do I want to do these Roth conversions when really I'm paying taxes today primarily to leave this pot of money tax-free to the next generation? You might say no. On the other hand, let's say we were to run that out and your break-even point was going to be 8 years out, and that Roth conversion had the possibility of creating a nice pot of tax-free money that a surviving spouse could access when they were now in higher tax rates. Then 8 years is not too bad, and you might say, well, that makes a lot of sense for us. And so, we run that break-even point person by person, but it's again, it's not consistent. It's not like, oh, the break-even point's always around 12 years. Unfortunately, I wish it was that way, but it's not at all. It is completely dependent on that person's situation as to where that break-even point comes in.
Mm-hmm. A couple of questions here, Dana, I'm going to put together for you. So first of all, when you build a bond ladder, what grades do you recommend to your clients? A, double A, double B, and so forth. And along those lines, how do you decide when to buy more bonds or CDs to cover the next few years of spending?
Question one, we look at bonds as the safe part of your portfolio, not where we want to take risk. So we're typically using agencies or CDs or, triple A quality municipal bonds. And so that is our approach. Sometimes, you'll have people who say, well, yeah, but couldn't we earn just a little bit more yield if we use corporate bonds or something else? But our view is, let's create that bond ladder. That's the certain part of your portfolio, and the risk we're going to take is going to be on the equity side. So there's a very specific purpose to bonds and why we're using them the way we are. Your next question, I believe, was, when do you extend the bond ladder? And I'm going to go back to this 2 slides and say, well, this slide has all of these squiggly yellow lines, right? These are all the historical, think of them as possible paths your portfolio could have taken. But in real life, we only get one yellow line. So let's say you're out here and, it's 2028 and you're a few years into retirement. And over that time, your portfolio has stayed up here in the green ahead of your critical path. Well, likely every year there's been some growth that has been sold, and I'm going to go back even to these slides. And so, 2025 is over. You spent this $110,000, but it was a good year, so we sold $90,000 of growth and we bought these bonds out here in 2033. And the next year, that process was repeated. And the next year, that process was repeated. And so then along comes a year like 2020, and we would say, nope, we're not extending the bond ladder at all that year. We're just going to wait until we have a positive year. And so it's generally a few things. It's, are you ahead of your critical path? There's a second factor that says, is your equity allocation over 60%? And the third factor is your current bond ladder, over or under 8 years in length? And so when you're looking at those 3 factors, if we had someone, let's say, that had an equity allocation of 70% and they are ahead of their critical path and they only have 6 years left on their bond ladder, that would be, yes, absolutely, we're extending and we're going to fill in probably year 7 and year 8. And so those are different factors that we look at, year by year to say, are we extending or not?
Stay on the slides for a moment, Dana, if you would. And in the slide with the fundedness ratios, the question is, can you take us through how you arrived at the investments at the beginning of the year and the estimated lifetime income withdrawals, or estimated lifetime withdrawals?
Yes, so let me go back. Up here, you see investments at the beginning of the year. So these were their starting account balances. And so that's where that 2.25 million comes from. And then essentially you're taking the present value. I don't have the actual, what's called gap column here, but it's the present value of all of their withdrawals over their lifetime. So it's a formula in Excel called net present value, and it's calculating out this 1.847 million. And so then we're comparing what did they have at the beginning of the year with what's the present value of those lifetime withdrawals. And in this case, we're using that 4% discount rate.
Okay, when modeling for Social Security income, should gross or net amounts be used?
Well, we use gross amounts, and then we are subtracting out the estimated Part B premiums, and then we're subtracting out whatever the taxes will be. And so all of that's getting factored into the analysis. Depending on how you're doing your plan, you might choose to use net, and then you wouldn't put your Part B premiums in your budget, or you wouldn't put the taxes just that are going to apply to that Social Security piece in your budget. So you could do it either way. Because we do so much tax planning, we have to use gross, because when we're doing taxes or looking at the tax impact, that is what's going to be reported on your tax return. And then you'll see on the first page of your tax return, there's two columns for Social Security. There's the gross amount and then the taxable amount. And so we have to use gross in order to accurately factor in the tax impact.
What are your thoughts on future tax rates, Dana? Do you expect them to remain fairly stable, or do you see tax rates increasing dramatically in the future due to U.S. debt?
Oh my goodness, where's my crystal ball? I have one in the other room. I need to hold it up for these. I don't know. When you look at history, our tax rates are some of the lowest they've ever been. And so by that measure, you could say they should be higher. We factor in the increase that is scheduled to happen in 2026. We think that's a prudent way to plan for it. And if for any reason, they freeze the rates at current rates, well, then great. It's really hard to say. What I can say is if you have a good plan, there's all kinds of things that are going to change over the next 20 or 30 years. In the amount of time that I've been in this business, since 1995 was when I started, there's so many things that have changed. And we have clients now that have worked with us for 22 years. There's so many things that have changed. And so every time we just adjust the model and it all works out. Right? Those changes aren't changes that make or break whether someone retires. It's having a planning process and a set of adjustments each year. That is what makes the difference. It'd be kind of like saying, well, I graduated from college and what if one day I become unemployed, right? Well, you build up a reserve and you do what you can, but when those things happen, you have to make an adjustment. And so to me, that's the important part, is knowing whatever you decide, it's not going to be static. We know that, right? We know how much has changed over the last few years. It's not going to be static. And so you just have to have a broad framework in place that makes sense. And then when those things change, you go in and you make the needed adjustments.
There's a question regarding the portfolio structure. So please help to distinguish the difference between retirement portfolio management by using a bucket strategy versus an AA strategy, which strategy, and one which one would be easier to manage, if either? I'm assuming asset allocation. So bucket strategy versus allocation. Yep. So
yep.
Total return.
So just for all of our attendees, an asset allocation strategy will typically say, I'm going to have a portfolio that's 60% stocks, 40% bonds, and I'm going to rebalance each and every year. And, over most normal markets, that strategy is going to work just fine. We prefer what's called an asset liability matching strategy, which says it's what pension plans do. Pension plans have to deliver retirement paychecks. And so it says, well, I'm going to buy this very specific asset that's going to mature and it's going to provide the cash flow available that year. It does take more management, I would say. Every year there's cash coming into the portfolio and you have to decide, does it get reinvested? Are we going to extend the ladder? Does the client need this cash? Versus if you're rebalancing and you're using, like in your 401k, for example, you can literally push a button and just rebalance, voila, and it's done. And so yes, it does take more management. We find the behavioral aspects of that are worth it. If you wanted to manage your own income ladder, there's a set of securities called bullet shares. So it's a package of bonds that all mature at the end of each year. And that becomes a very easy way to create, it's like buying an ETF in your account. It becomes an easy way to manage and create your own bond ladder. So all the cash that you would need, let's say for 2024, you would have bought a bullet share that matured in December 2023. That cash would be in your portfolio. Right now, you would go be putting it in money market, and then you would be drawing it out on a monthly basis for retirement. So, is one strategy going to be superior to another in terms of returns? Maybe, but we won't know that until we look back, 30 years in the future, right? Most likely there's going to be periods of time where one strategy or the other outperforms. Wade Pfau did a whole paper on this. It's on Advisor Perspectives. I can't remember what it's called, but he basically said it's something like time segmentation and bond ladders are these a superior strategy. So if you Googled Wade Pfau and time segmentation portfolios, you're probably going to find this article. And it did seem to show that these bond ladders following a particular process, at least in his research, had a higher probability of success over time. We view what our work is if there's research that says, hey, this has a higher probability of success, well, that's what we want to do. And, that's why people hire us. I don't want to be here in 20 years and thinking, oh, sorry, we were too optimistic in our assumptions, and so too bad you're out of money. That's just simply not okay. And so we feel like we don't feel like it. We do have a fiduciary obligation, and, we want to use the strategies that have been, at least what research shows today. We all know these things can change too, but it shows that it gives you a higher probability of success over time. And sometimes those strategies do require, more hands-on or more management.
In cash flow planning, does it make sense to take into account the possibility of high medical costs that are not covered by health insurance early in retirement? And if so, how?
So if there's a specific thing, so for example, if you have a known health condition or, things that you're pretty sure are going to happen, then absolutely yes, right? You would want to add that expense in. If it's not a specific thing, but it's something you want to test for, that is where those reserve assets come in. And so as we think of it, if I have to use every asset you have to make your plan work, it's not a good plan. But let's say I've left out home equity, and let's say I've left out $100,000 that you have in money market. Well, those two things are going to be enough that you're going to be able to weather this health situation at least long enough to buy time and make some adjustments. The other thing that typically happens is when health situations come up, you're not doing the vacation type of traveling. And so often it's one type of expense that replaces another. If you are a fairly well-off person and you know that if a health situation came up, you would throw everything in the kitchen sink and all, go try every alternative treatment you could think of, then maybe that is something you want to set aside more reserves for and say, well, if this happened, I know I would set aside this amount of reserves, and you can test for that situation. That's how you would test for it, is to say, if I drop in this extra expense and it happens in year 3 of retirement, does my plan still work?
How do you value the income from a mutual fund? Is the dividends, the long-term capital gains, or the change in the value of the funds?
So I'm not sure, like, we value, the way we use it in our planning model is it's an asset. So if I were to go back to this slide, right, this non-retirement account would have mutual funds in it. And the amount of interest and dividends that those mutual funds were expected to generate would be included here in this tax calculation. So here we see net long-term. This would be long-term capital gains and dividend income that we were expecting to come in. So that's how we include it in the plan. In terms of valuing it, it depends. If you have a plan where your goal is only to spend the cash flow, then you would just look at those dividends coming off it as available. But most of the time, there's going to be times where you're going to have to sell some of that fund. And then what's going to show up as capital gain is going to be the difference between your cost basis and what you sell it for. And that also depends, because if you had dividends reinvested over time, that's going to have increased your cost basis over time. So hopefully that answers the question.
Here's a question, Dana, about a pension. So my pension was sold to a large insurance company, and I think it could be any number of large insurance company. He does specifically name it, but and it was replaced with an annuity. How much should I worry about the solvency of this large insurance company? The amount is greater than the Pension Benefit Guaranty Corporation insurance provides.
What do they say? 99% of what we worry about never happens. So, I would say you probably shouldn't worry too much. There's nothing that worrying is going to do, right? So most of the time, and well, at least historically, when large insurance companies, we'd have to look up the rating on that company, but it's probably a good quality company if the pension plan, moved their assets to it. And so those high quality companies, I don't know if there've ever been any, but I think there's one or two that went under, and another company absorbs those assets and liabilities. And so the insurance commission steps in and they organize all of this. And, historically, we've always seen that happen in an orderly fashion. I have seen cases where the cash flows got disturbed for a bit, so there could be a pause as the new carrier was taking over. But the likelihood of that, the amount of time you might spend worrying about it versus the likelihood that it's going to happen, and there's not a whole lot you can do about it. I would say, if there becomes any rumblings that that's going to happen, then that's the time that you start planning. But I would say most of the time, go out, enjoy your retirement, and that's a very unlikely thing to happen.
Planning question, do you also plan out for healthcare subsidy advantage when planning for which type of account withdrawals prior to age 65?
Yes. That's a simple answer.
Yes, we do. That's what
yes,
planning
we
is
do.
Yeah.
So if we think you can qualify for the healthcare subsidies, absolutely, we take that into account, and then that would be a reason not to have any IRA withdrawals early in the plan in some cases.
What inflation rate do you project for your plans?
Typically, we're using 3% as a starting place. But for higher net worth clients, or as we want to account for the slow go years, sometimes later in the plan, we are dropping that to 2%. And that's based on long-term historical averages of how inflation actually impacts retirees and how it impacts them in different demographic sectors very differently.
Mm-hmm. And healthcare is typically at 5%.
And healthcare is at 5.
Yeah.
Yeah.
Dana, what goes on the line called below the line deductions on your spreadsheet? The first word on that line was cut off.
Oh, it just says less below the line deductions. So below the line deductions could be, in this case, I believe it's just your standard deduction that we're looking at here, but it could be things, yeah, typically it's just your standard deduction. It could be charitable, it could be mortgage interest. So anything that would fall into those types of categories that you were itemizing deductions would fall into that category.
Okay, and we know that this question always comes up. So the first part of it is, what topic did you cover at the Bogleheads conference? And also, any update on your plans for writing your next book?
Oh my goodness. So on the Bogleheads conference, what I talked about specifically was how you build a asset liability matching portfolio. And so that is available on YouTube on the Bogleheads channel. And so it's about 30-minute presentation. And for those of you interested in learning more about that particular portfolio strategy, I would encourage you to go check it out. It was a lot of fun. I absolutely loved talking at that conference. I usually talk at conferences full of other advisors, and this was full of people that are out there planning for their own retirement. And so it was just really, really, really cool. And hopefully I'll get to do it again. The second question, my book, oh my goodness. So, we were just talking about that with someone here today. I don't know, because it's such a time-consuming endeavor to get it all updated, but it's definitely on my mind, and that's the only update I have.
Okay. A couple of comments about the seminar was great. And another one, they should have given you more than 30 minutes. So for a single person with no legacy concerns, do Roth conversions still make sense?
Sometimes. And so the reason I say that is sometimes that single person is going to have years where their tax rate would be so low in early retirement, and then much larger required minimum distributions later, that there's simply a tax arbitrage opportunity for them to do Roth conversions. And possibly by doing those Roth conversions, that's going to keep their Part B and D IRMA premiums from being higher later. So sometimes it does, and I've seen that with people with larger portfolio sizes. But in many cases, no. You take a single person with no legacy goals, and they don't have that tax arbitrage opportunity, then there wouldn't be a big reason to do them.
Is there a big disadvantage of using bond funds instead of a bond ladder?
So the bond funds, as we saw last year in the news, right, 60-40 portfolio has its worst year ever. Those were all over the finance headlines. Well, when interest rates go up, bond prices go down. Now, the bond prices go down whether they're in a fund or not. But the challenge is, if they're in a fund and you sell it, well, you get that lower price. When you own an individual bond, you're gonna hopefully, if you've done it right, own that bond till it matures. So although on paper the bond price went down, it's not going to impact you. You're going to hold that bond to maturity. And so back to one of those behavioral aspects, we find that if people see a mutual fund that's down substantially, they, oh my gosh, why did we buy that? We should get out of it. When it's an individual bond and they realize, oh, if I hold that to maturity, I get, exactly what I was supposed to get. It somehow mentally brings that peace of mind. Theoretically, if you own a bond fund with, let's say, a duration of 4 years, and I'm not going to go into what duration is, but if you're a finance person, you can Google it. Then if you own that bond for 4 years, that bond fund, it should have the same outcome as a bond you would buy that would mature in 4 years. I say that theoretically because in a mutual fund, there's also other investors. And if those other investors sell out of the bond fund when it's down 20%, well, the portfolio manager is going to have to liquidate some of those bonds instead of being able to hold them to maturity. So in our opinion, when we're talking about cash flow that we want to have, be a certain thing to spend in particular years in retirement, we prefer the individual bonds.
Do you do any planning for Social Security, for the possibility that Social Security may run out of money?
Well, no, although I will we will if someone really wants to see it that way. But if you go back in history and you look in around 1983, the Social Security system was supposedly 3 months away from becoming insolvent. But that was at the point in time where they passed a 50-year fix on Social Security, which runs us almost exactly 50 years into the future to the current time frame where they say Social Security is going to run out of money. It's not really going to run out. All they're saying is at that point in time, there's enough money coming into the system to cover about 75% of the projected benefits that go out. There are all kinds of actuarial ways that could be fixed and easily and without too much impact on any individual demographic segment. And the problem is there's not any, political motivation to fix it. So when you look at what happened in 83, they literally passed the fix a few months before it was supposed to run out. And so while all of us who are planners would love to see something in place so that we didn't, always have this on our minds, the reality is it's unlikely to be something that they pass or fix until it becomes imminent and urgent because of course, that's the way the political system works right now. In terms of us being concerned about it, no, we're not.
This is maybe more kind of your thought process type of question, Dana. What range amount would you need to be able to live off of dividends and capital gains? Say you need about $10,000, I'm assuming $10,000 a year. How many millions? So what would be the methodology for kind of figuring that out if you just wanted to live off dividends and capital gains?
I mean, you could look at the dividend payout of, a mutual fund, and you could focus on funds that have higher dividend payouts. There's all kinds of risks to doing that. Generally, I've seen those dividends usually run around 2%. You could also see what was the historic capital gains payout from those funds. Those can vary a lot from year to year. So in terms of having consistent cash flow, to me, that doesn't give you much consistency. But, you could just, assume that, you could assume a 2% yield, and then you could say, okay, for every $100,000 I had, if 2% was the dividend, that's going to give me $2,000. So if I wanted 10,000, I would need $1 million to live off that 2% dividend.
Where in your sequence of spreadsheets would you calculate Roth conversion amounts for the years before RMDs and Social Security?
I think we answered that question.
We did, yes. I'm sorry. The one above it. I'm sorry. How can annuities keep up with inflation?
How can annuities keep up with inflation? Is that the question?
Yes. It's just how can annuities keep up with inflation?
Most of the time they don't. So, there are some annuities that have inflation adjustments, but they're rare. And so when you look back to, I was actually just on this slide, these, slow go years, and the fact that typically retiree spending doesn't keep pace dollar for dollar with inflation, there's certain parts of your retirement income plan, like Social Security, that will have an annual CPI adjustment to them. And then you have your portfolio, which if designed correctly should help you keep up with inflation. And so the annuity piece would be a part of it that wouldn't. That piece of the portfolio they're all different pieces of a puzzle. One is not going to solve the whole problem. They're designed to work together to give you a outcome that helps manage the different risks that you face in retirement.
Should one spending plan include annual gifting to children and grandchildren, or wait for the transfers via IRA designated beneficiaries?
You know, some of you have heard the story of my grandma on spa was in the first class in Illinois where they allowed women into medical school. She met grandpa and they had a practice in Mitchellville, Iowa. And when grandma and grandpa passed, there was 3 children, my dad and 2 aunts. And, I don't know, dad's actually never told us the amount that he inherited, but he did decide that he wanted to spend a lot of the money on us all doing things together as a family rather than us waiting for him to kick off. And so we did some amazing trips. We've hiked Machu Picchu. We hiked the Coast to Coast Trail in England. A few years ago, we all went to Italy together as soon as it reopened after COVID. And these have been absolutely amazing experiences. And so for me to say, well, wait until they get the money. Well, I know my dad, he's a planner. I'm sure he ran through the numbers with his financial planner and made sure that the amounts he was spending were reasonable. They weren't going to put his own retirement at risk later. And so that would be my answer. If there's things you can do for your family now, it's going to make a difference for them. You get to be there to see that difference that it's going to make, or things you can all do, experiences you can have together. They're going to create those memories. Well, include those things now. See if it's feasible. That I think is far better than, someone receiving a huge lump sum at some point in the future.
If we both have brokerage and traditional IRA accounts, are we better served to use the brokerage accounts for expenses and do Roth conversions to leave Roth inheritance, or spend traditional IRA for expenses and leave the brokerage as an inheritance, which gets a step up in basis?
Well, it really depends on your goal, right? So yes, your brokerage account assets get a step up in basis. So if your goal was to maximize the amount that you're going to leave to heirs, that is a completely different goal than you creating the most tax efficient retirement income plan for yourself. And so if I don't know your tax rate, so it's hard to know. But if you were to, spend the IRA assets first, you're going to pay the tax, right? And so you're prepaying the tax for your heirs, and then they're getting a step up in basis on the brokerage assets. And so I don't know that either's right or wrong. The real goal would be if you were saying, well, my goal is to maximize the amount that I pass to heirs, right? Are there other ways of doing that rather than just your portfolio withdrawals? So, maybe Roth conversions would be a great way to actually maximize the amount that you pass to heirs. So it really would depend on what is the number one goal.
Do you prefer bond ladders to annuities for guaranteed income? If so, can you tell us why?
They're different. And so we use both. and so when I think about it, back to those different puzzle pieces, an annuity generally is designed to pay out for life. So it's hedging against that risk that you live longer than average. And the longer you live, the higher the internal rate of return on an annuity payout. A bond ladder is more of like it'll allow some optionality in your plan. We don't want to create a 20 or 30-year bond ladder, although, you do read about that. That's not my preference because things change, your spending needs change. You might decide to move in retirement. There's just all kinds of things that change. And so they allow for more optionality, right? The bond ladder gives you that peace of mind to know that, let's say, the next forward-looking 6 to 8 years are covered and solid, and then you just can keep adding on to them. So we don't think of them as either or. They're very different vehicles, and they can each have their place, and sometimes they both have their place at the same time in a solid retirement income plan.
Here are a couple of questions, Dana, that are related to Larry and Ellen. So the first one, bear with me one second, sorry. In the example used in the presentation, the couple withdrew needed funds from tax-deferred as well as taxable accounts in the early years. Is this typical, or is it preferred to take first from the taxable accounts before moving to the tax-deferred?
Well, this was intentional. So in Larry and Ellen's, so if we go back, right, we specifically said this is how much we want to withdraw from each of these retirement accounts. And so what was the actual question? Sorry, Nancy.
No, it's okay. Let me read it again. In the example used in the presentation, the couple withdrew needed funds from the tax deferred as well as the taxable accounts in the early years. Is this typical, or is it preferred to take first from the taxable accounts before moving to the tax deferred?
So I hate the word typical, because in this client's plan, this was the preferred strategy. And so in someone else's plan, maybe somebody that has a larger pension, for example, the preferred strategy might be to delay any distributions until required minimum distributions start. Or in some cases, the preferred strategy would be to have Roth conversions. You would see Roth conversions in here. So it's really hard to say whether it's typical or not, because everybody is different and they have different sources of income, whether that be pensions or deferred comp or stock options or annuities or rental property. And so, you know, that all impacts which strategy maximizes the assets you have. So we use the analogy of, you know, how do you squeeze more juice out of the orange? Well, you know, that depends on all of those components to your financial plan. So I wish I could tell you that this was typical or normal, but it completely depends on your individual circumstances.
So staying with this example, the question is, you seemed very generous with the distributions based on their financial assets, which did not include their residence, but their financial assets. You didn't mention any Roth conversions for this couple. Were conversions not mentioned because of Larry's age being so close to RMD, or was it because, or was it determined that the conversions would have caused higher taxes?
In their case, you know, if we go back to this tax situation, you know, their tax rate stays pretty static at this estimated 25% throughout retirement. So there simply isn't much opportunity to do Roth conversions. And that's why, you know, instead of converting, we withdrew the assets. Their goal was not to, they didn't have any children. And so, you know, why do they want to do Roth conversions? You know, that's not their objective, is to pass along tax-free money to heirs. And so for their plan, it simply didn't work out. In some plans, there would still be this difference, right, between Larry's 69 and 73 when his required minimum distributions would start. You've got Social Security kicking in here at 70. That can often limit the opportunity to do Roth conversions. So, you know, that results in these tax rates being pretty static. Hopefully that answers the question. They're just, in their case, there isn't really an opportunity to do it.
Yep. Question here, if I have no debt, no big expenses coming up, a good 401k, pension, and 5 years out from early retirement, would you buy a bond ladder or CD ladder with the current interest rates?
Well, I would, yes. So, you know, if you have heard me talk about my own retirement plan, I'm still a ways away, but I'm 52. And what I plan on doing around the age of 55, I'm 100% equity right now, is around the age of 55, I will look forward and say, well, if I were to retire at 65, which I don't think I will, but I love what I do. I don't know why I would retire at 65, but you never know. If I were to retire at 65, I will say, here's the amount I would want to withdraw. And so at 55, I would reallocate a portion of my equities to a bond maturing at 65. And then I would just keep that process going. And by the time I got to 65, I would have my 8 to 10 year bond ladder already built and have just done it gradually. So if I were 5 years out, and still 100% equity, or maybe, you know, have money in bond funds, I could shift those bond funds to individual bonds. Or if I was 100% equity, I would certainly start making that shift and buying my bond ladder.
What is the reasoning behind not including real estate in plans?
Well, we do include real estate in plans. We just typically aren't including it as an asset available for retirement cash flow. And so most people are going to live in their house, and we find that they don't want to have to sell it one day to make their plan work. Now, there's cases, we have clients that have 2, 3, even more properties where we do have that asset being sold and coming into their plan. So one of the clients I've worked with the longest, he was a dermatologist, and here in Arizona, they had a house here, they had a house in Malibu. And so eventually they sold the house in Malibu and bought a place in Colorado. And they also had an interest in a commercial property from the practice that he was a partner in while working. And so from the very beginning, real estate was a big part of their net worth, and their financial assets were a much actually smaller portion. And so we knew from day one that commercial property interest would have to be sold within a certain, I think, the first 10 years of retirement. And we knew they would have to eventually get down to one property. And so the commercial property sold, and then about 5 years later, they sold the Malibu place, and then they had the place in Colorado, and they had a place in Sedona. And just this past year, they have now parted with the Sedona place, and they are down to one property. They're in their late 80s now. But this was a plan from day one, almost 20 years ago. We knew those things would have to happen for their plan to be sustainable. So absolutely, we do include real estate in the plan. Again, like so many things, it just depends on the client's individual circumstances. And if they're planning on living in that house for the rest of their life and they don't have long-term care, then usually that is something that's not included as cash flow, but we're setting it aside as that reserve asset that could be used in that situation.
How do you handle pensions with a COLA, where the percent is usually less than inflation, versus without COLA to compute your income timeline?
We just add the COLA. So if you go back here to this income timeline, let me go back here, right? Just like Social Security, there's a COLA. So you see this Social Security amount going up each year. And on the pension, you see that it's fixed because this pension didn't have a COLA. And so it would be exactly the same way. If there was a COLA, you know, if it was 1% or 3%, whatever it was, we would apply it to the pension. And if there wasn't, then we don't apply it.
And I think, Dana, this may be our last question here. Assuming one has several types of accounts, is it better to withdraw first from a taxable account versus a tax-deferred account? And in what situation is it not better?
So I know we've had this question come up several times, and you know, unfortunately, it completely depends on your circumstances, right? Yep. As I've mentioned, if you have a lot of fixed income pensions in your plan, then in most of those scenarios where people have a lot of fixed income pensions, it's going to make sense to defer those tax deferred accounts. But we see lots of other situations, particularly where people might have a mix of assets, brokerages, IRAs, and Roths, where it does make sense to take some money from the IRAs even before you have to. There's no way to know without projecting out your tax rates and your own income plan. We just haven't found that there's a really good one-size-fits-all rule to that.
Okay, and that is the last question. Thank you for the presentation, very informative. So lots of nice comments, but that would be it for questions, Dana.
Great. Well, I am sorry about the sound problems. Obviously, we have some more troubleshooting to do before the next one to get all of this to work. And I really appreciate everybody's time. And Nancy, I really appreciate your help. And so have a great evening, everybody.
Thanks.